What is a profit?
Forecasting is simply trying to predict what might happen in the future. So it simply gives us early information so we can get ready and make better plans. So in business, forecasting help managers and owners to decide what to do next. So they help in how should they sell and how should they stock. So it's not always perfect, but it really helps avoiding surprise and preparing for the changes. So in simple words, forecasting is all about being ready for what's ahead.
So, hi everyone! Today we were going to talk about the gross profit. Let's use the XYZ Trading financials for 2017 as an example. So, we have the net sales of 734,000 and the cost of sales of 577,000. Net sales is the total amount of sales after deducting returns and discounts. Cost of sales includes the direct cost of producing and selling the products. To calculate the gross profit, we subtract the cost of sales from the net sales. Let's do math. We have the cost of sales, which is the 734,000, minus or subtract with the net sales, which is 577,000, equals to 157,000. So that is the gross profit. Now that we have covered gross profit, let's explore another important concept in business finance, profit and cost. Understanding these elements is crucial for making informed business decisions. Profit, also known as gross income, is the amount of money earned from sales after deducting the cost of producing of a business financial performance. Cost refers to the total outlay required to produce a product, including the purchase price of materials, labors, and overheads. It's the total amount price to create and deliver a product or services. Profit, let's calculate the gross profit rate. We've calculated XYZ Trading's gross profit to be 157,000, but what does this number really tell us about the company's profitability? To get a better understanding, we can calculate the gross profit rate. The formula for the gross profit rate is gross profit rate is equals to gross profit divided by net sales times 100, which is the gross profit is equals to 157,000 divided by 734,000 multiplied by 100.
Gross profit rate was the 0.2139 times 100, and gross profit rate is equals to 21.39%.
I will give some simple explanation about profit margin rate. The operating profit margin rate, how much profit a business earns from its operators before interest and taxes. After converting operating profit expenses, it tells how efficiently a company is managing its cost to generate profit from its sales. The examples of shown. Gross profit is 167,000. Less operating expenses is 90,000. Operating profit margin is 67,000. So, this means that after paying for all operating costs like rent, salaries, and utilities, the business earned 67,000 from its core operations. These rates help determine how well a company controls its expenses and how profitable its regular business activities are. A higher operating profit margin indicates better efficiency and stronger financial performance.
Ngayon ipapaliwanag ko kung paano kumpitin ang operating profit margin rate. Ang unang formula na ginamit ay operating profit margin is equals to gross profit minus operating expenses. Ang gross profit kanina ay 157,000 pesos at ang operating expenses naman ay 90,000 pesos. Ima-minus po ito sa gross profit minus operating expenses. Sa kabuuan, merong 67,000 pesos sa operating profit margin. At sa pangalawang formula naman po ay operating profit margin rate is equals to operating profit margin divided by net sales times 100. So, ang operating profit margin rate ay 67,000 pesos na tinotal kanina at i-divide po ito sa 734,000 po yung net sales. At i-multiply po ito sa 100. At ang sagot po nito ay 9.13%. Yun lang po.
Net profit margin rate. This is a key financial metric found on the income statement that shows a company's profitability. To calculate it, we start with the operating profit margin. For example, if the operating profit margin is 67,000 and we subtract income tax by 20,000, we get a net profit margin of 47,000. It's important to note that in the case of XYZ trading, interest expense isn't included in this calculation. Only income tax is deducted. The net profit margin is a vital tool for understanding a company's overall financial health and profitability.
The net profit margin rate is computed as follows. If you can see the net profit margin rate equal net profit divided net sales times 100. So 47,000 divided by 734,000 and times 100. So is equal is 0.640 times 100 and the total is 6.40%. Net profit margin rate. Ito, this, ito, 6.40%. The net profit margin shows how much profit a company earns for every peso it makes from sales. A higher percentage means the company earns more profit. Why is the net profit margin important? Measure of profit and cost analysis and comparison with others. How is the net profit margin calculated? It's calculated by dividing the net profit after deducting all expenses by the total sales, total revenue, and then multiplying by 100 to get the percentage. And The net profit margin should be compared to other companies in the same industry to know if the company is performing well or not. The net profit margin can change over time, so it is important to monitor it. That's all.
Next is the quick ratio. Quick ratio is a financial measure used to determine how well a business can pay its short-term obligation using its most liquid assets, meaning cash, marketable securities, and account receivable. It includes inventories because these are not easily or quickly turned into cash. A high quickly ratio indicates that the company can meet its short-term debts without relying on selling inventory, showing strong financial stability. Next is the financial statement. On the other hand, these are essential tools for a business. They provide a clear picture of the company's financial performance and position. This statement help management communicate past achievements and future plans. They include records of sales, expenses, profits, and losses, which are vital for making informed business decisions and maintaining transparency with investors and stakeholders.
Talking about investment at return or ROI. We're talking about two: net income, average, and total asset. Net income, the profit a business generates after deducting all expenses. Average total asset, calculated by adding the total asset at the beginning and end of period by dividing by 2. Example, suppose a small business has a net income of 50,000. The average total asset from the same period are 250,000. Number 1. Calculate ROI. ROI, return of investment, 50,000 and 250,000 equals 0.20 or 20%. An ROI of 20% suggests that every peso of asset invested, the businesses generate 0.20 pesos in net income. It's a measure of how well the company is using its asset to generate profit.
The slide you see here clearly lays out the definition return on investment. It measures the amount of the net income per peso invested to the business. To compute this essential figure, we use a simple yet powerful formula. Now, let's break down to the two components of that formula. The first one is the net income. This is the company's profit after all operating expenses, interest, and taxes have been deducted. In the context of the projected income statement we'll look at, the gross profit before tax is the key step toward finding this. The second one is the average total assets. Since assets can fluctuate throughout the year as a business buys and sells equipment or inventory, we don't just use the total assets at the one point in time. Instead, we calculate the average by dividing the sum of the total assets at the beginning and the end of the period. This provides a more stable and accurate representation of the capital the business was using to generate its income over that time, applying ROI to the 5-year projection. Now, let's turn our attention to the data we have for the Fit Motor ready-to-wear online selling business. We have a projected 5-year income statement. This statement forecasts the business performance from year 1 through year 5. Based on the key assumptions, a yearly increase in revenue of 5% and a yearly increase in cost of 5%. If you look at the table, you'll see a clear progression. The revenue grows consistently, starting at 1,545,673.95 in a year and reaching 1,878,773.34 by the year 5. While the cost also increases, the business is projected to maintain a healthy and growing gross profit before tax, which is the profit after the direct cost of the selling of the goods are subtracted. This profit grows from 332,398.56 in a year 1 to over 404,032.53 in a year 5. In summary, the return on investment is a critical tool. It takes the performance shown in the income statement and relates it directly the assets used. It's the ultimate performance ratio that investors and management use to assess whether this ready-to-wear online business is making smart, profitable decision.
As a future entrepreneur, one should always remember that nothing is permanent. In the field of entrepreneurship, what is applicable to an entrepreneur may not be applicable to another. Certain things may happen to one entrepreneur but may not happen to another. Entrepreneurship should be practiced not as science but as an art. Creativity should always be applied to entrepreneur by regularly evaluating the market and the environment and responding to the change in them. Example po, ibig sabihin nito, ang negosyo ay hindi lang basta pagsunod sa mga rules o paraan. Kailangan din ng pagiging malikhain at marunong magdiskarte. Hindi pare-pareho ang karanasan ng bawat negosyante, kaya kung ano ang gumana sa isa baka hindi gumana sa iba. Dapat marunong mag-adjust at mag-isip ng bagong idea para makasabay sa pagbabago ng negosyo at paligid.
Owner of an ordinary small business has the freedom to manage and operate. Ideally, he should prepare business activities, which are done easily. However, the entrepreneur has to perform the entrepreneurial activities currently, regardless from wherever undertaken. Easily is not important in activities are performed currently. Example, a sari-sari store owner chooses to sell product that easily to manage. Even if restocking and bookkeeping is a difficult, the owner still does the properly to keep the business running smoothly.